Welcome back to the channel. Today we're going to talk about money, specifically about the history of money and what a token is. Stay tuned. A very long time ago, we were bartering certain goods for other goods. But it turns out that if you have 50 pounds of potatoes and you want to barter them for 50 pounds of tomatoes, maybe there's a problem with the durability of the tomatoes, for instance. So there has to be some other way to do this, and money provided that other way. It could store value, in this case the value of 50 pounds of potatoes, and store it until such a time where you actually needed the tomatoes or a part of the tomatoes. So this means money can store value and it can transmit value, because you can also take part of that money and give it to somebody else, and that somebody else can buy 50 pounds of tomatoes or a fraction thereof. So this is the basic function of money. It dissociates the goods from the value, and you can trade the value independently and you can store it indefinitely. What are the characteristics of money other than it can store value? For this, I actually have to look at my phone here. The characteristics of money are durability, portability, divisibility, uniformity, limited supply, and acceptability. Now, I think most of these are clear and self-evident, but keep them in mind, because we're going to talk about this again when we talk about central bank digital currencies, government supply of money, and also programmable money. And you will see that, in fact, some of those characteristics will be manipulated in this context, which is important when we talk about trust. Each town, each region actually used to have its own money supply, minted its own coins, and that was okay as long as those places weren't that much intertwined economically. But with the rise of modern nation states, it became really inefficient. So what happened was that those banks that individually did their business, or those towns that issued their own money, they started to give more and more of the control to a national entity. In this case, it will be a central bank. And there's a whole history of central banks, and I would invite you to really dive into this history. Actually look that up. There's plenty of videos, there's plenty of literature on the internet on this, or in your library for that matter. And it makes a lot of sense, because honestly, if you try to understand cryptocurrencies, the crypto universe, you really need to familiarize yourself with the history of central bank money and its evolution, in fact. So that's very important. And today we're going to cover some of those aspects, but we can't do everything. So the central banks started to issue national currencies that would unify the currency of a country, of a nation. And in fact, you know examples also where actually several nation states bond together and form a common currency like the euro, which is composed of several European currencies. Central banks, through the control of money supply, can actually execute a monetary policy which can have an influence on the growth of the GDP. It can have an influence on inflation and other economic factors. And again, I would encourage you to actually look those up and try to understand how an economy actually works and what these factors actually are. So central banks have this very, very important role. Now, let's get back to money. As the money itself became further and further detached from its value that was associated with the goods that it actually represented, it became important to have the money attached to something that everyone could agree on has value. And that something was decided to be gold. Gold has an intrinsic value. It is seen as intrinsically valuable. There's a limited supply. It's kind of hard to produce, but it's not impossible. And in this way, it represents a store of value. Money now became a right to have a certain amount of gold delivered to you physically. And that's how the first banks actually emerged. So money that was issued were actually notes that said whoever has this note can go to the bank and have a certain amount of gold delivered physically. This is how this connection between gold and money actually started to emerge. Now, fast forward to the 20th century. The final year of the Second World War, there was a big conference convened in Bretton Woods, New Hampshire. 44 nations came together and they negotiated an agreement that was later to be known as the Bretton Woods Agreement. It took on certain lessons from the interwar period, and it actually had several outcomes. One of them was the creation of two really important institutions, namely the International Monetary Fund. The second big institution is the World Bank, but it also created something else, namely a global reference currency, or what is known as a reserve currency, a global reserve currency, which at that time was chosen to be the US dollar. Now the system, what we now call the Bretton Woods system, worked like this. The US dollar was pegged to the gold, to the value of gold. At that point, an exchange rate of $35 for each ounce of gold. And all the other currencies in that system were themselves pegged to the dollar. And the spread was kept very tight to like 1%, so there wasn't much movement allowed actually in this system. And this gave the whole world the same kind of stability that before that national currencies had provided over those regional currencies. So this system really defined the post-war period. It came fully into operation in the 50s, but until the day where then US President Nixon in 1971 uncoupled the price, or unpegged the price of gold from the US dollar. And this actually led to the demise, to the collapse of the Bretton Woods system in 1973. And this is the situation that we have now, where basically each country can define their own currency policy. Either they float their currency or they peg it to something else, to a basket or whatever. This is one of the outcomes. The other outcome really is that now there was no longer a limitation on the amount of money that a central government, or a central bank in fact, could print or could produce. And that has fundamentally changed as well the outlook on how monetary policy looks like. And it is particularly relevant today when you think about all the measures that are being implemented in order to provide stimulus to the economy, namely the massive infusions of freshly printed money from the Federal Reserve in the United States, from the central banks in other states, in other countries, into the economy. In an economy, an oversupply of money typically causes inflation. And that's a real concern, specifically when you think about the quantitative easing measures that happened in the wake of the 2008 financial crisis, or the massive amounts of stimulus money that is now flowing into world economies from the central banks. We can already see some of that happening, and this is a real concern. And it's important to keep that in mind also when we talk about cryptocurrencies, specifically Bitcoin, in later episodes. Before we end today's episode, I would like to bring up another concept, namely the concept of a token. It is related to money. What is a token? In its most generic form, a token represents the right to something that isn't currently here or is hard to materialize. As an example, when I say, as a token of my appreciation, I would like to give you this, then this token is this present that I give. It represents my appreciation that is otherwise hard to materialize. The same is true for things that are absent. So a token can be a right to something. It can be a right to a license. It can be a contract. It can be pretty much anything that I can encapsulate in this concept. Another characteristic of a token is the fact that it's easily transferable. Whoever holds the token has the right to whatever this token represents. For instance, if that token represents the right to ride the subway, I can give it to somebody else, and that person can then exercise that right. So that's a very important concept to keep in mind. For today, I think we have covered the history of money, and we know what a token is. So we're ready for the next episode, in which we will talk about the future of money.